It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader in less than 5 minutes per week. The video newsletter is brought to you by TradingTips.com.
Welcome to this week's episode, Short Ratio, what it is and why it matters. First, let's review the process of short selling. This occurs when a trader, such as yourself, borrows shares of stock from his broker and then sells them on the open market. You do this in the belief that the stock is going to be going lower, and thus you'll be able to rebuy shares at the lower price in the future. Imagine XYZ is trading at $30 per share, but you think it's overvalued. You can borrow shares from your broker and sell them at $30 each, the market price. Then let's say the stock falls to $25 a share. At this point, you could buy back shares on the open market, which is called covering your position, and return them to your broker. You borrowed shares and you returned identical shares, but in the meantime, you made a $5 difference per share. Of course, the opposite could happen. XYZ could go from $30 to $40 or even $50 or $60 per share. In this case, you'll have to buy back the shares at a higher price, and thus you'll lose money. At what point do you have to buy back your shares? Must you do so in a certain amount of time, or when the stock has fallen or risen by a certain amount? To the first question, the answer is no. You can keep shares shorted indefinitely. You may have to pay interest on the shares you've borrowed, however, if you use margin. To the second question, the answer is two-part. First, you never have to cover your position due to a stock's price having fallen. You decide when to cover and take profits. But as for the second part of the question, yes, you can be forced to sell if the price of the stock you shorted rises too high. After all, your brokerage account has to have the funds and/or margin credit to buy back the shares. If you shorted 100 shares of XYZ at $30 and the stock then went to $100 per share, you would need $7,000 in equity and/or margin credit in your account, or else your broker will make a margin call and force you to cover the shares. This is where the concept of a short squeeze comes in. A short squeeze occurs when short sellers begin buying back shares, usually due to margin calls or just generally throwing in the towel, i.e. giving up on the idea the stock's price is going to fall. If a large number of short sellers decide to cover their positions, this can throw the supply and demand of the stock out of whack, thus forcing up the price of the shares. As this happens, more short sellers get margin calls or throw in the towel, and thus the price of the stock goes higher, which then makes more short sellers want to cover their shares, pushing the price of the stock higher yet. It can be a vicious cycle if you're on the short side. If you own the stock, however, a short squeeze can be a wonderful thing. With this in mind, wouldn't it be great if we could know which stocks were likely candidates for being short squeezes? The good news is, we can. The statistic to look for is called short ratio. The short ratio takes into account the number of shares sold short and the average daily trading volume of the stock. For example, if a stock had 2 million shares sold short and its average daily trading volume was 8 million shares, then it would take 4 days, 8 million divided by 2 million, for all the shares to be covered. This would give the stock a moderate short ratio of 4.0. Generally, a short ratio of 5 or higher is considered bullish. Now you might think that a lot of people shorting a stock would be an indication that the stock is likely to go lower, but history shows us that when an idea becomes that popular, it is usually overdone. More likely is that the stock will find itself in a short squeeze and will go higher. This is especially true of stocks with even higher short ratios in the teens or even 20s. By contrast, stocks with short ratios of 3 or under are generally considered bearish. The thinking here is that the stock is undershorted and as a result overbought. Supply and demand are out of whack, and thus the stock is likely to go lower as the two forces balance, with more sellers coming into the market. So where can you find short ratio information? It's actually pretty easy to find online. Here at Yahoo Finance, a stock short ratio can be found by clicking on Key Statistics, and then scrolling down to find short ratio under the heading Share Statistics. It's important to consider, though, that short ratio is just one factor you should check before buying or shorting a stock. The stock's fundamentals, general business outlook, and many other technical factors should be taken into account. To recap, short ratio lets you know how heavily shorted a stock is in relation to its average daily trading volume. Short ratios of 5 or higher indicate a stock is oversold. Short ratios of 3 or under indicate a stock is overbought. The higher a stock's short ratio, the more likely it is to experience a short squeeze. But of course, it is just one of many tools that traders should use. Well, that's all you need to know about short ratio. Good luck!
This Trading Tips video newsletter has been brought to you by Manny Backus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system. The First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. Do you want to view more Trading Tips videos? Visit tradingtips.com. Sign up for our free video newsletters. Become a successful trader by visiting tradingtips.com.